Hello everyone, my name is Taylor Richards and today I'll be presenting my proposal on implementing a coupled exit tax on expatriating corporations. Coca-Cola, Burger King, Liberty Mutual, Pfizer, Medtronic. What do all these companies have in common? The answer is that all of these companies have undergone corporate inversions within the past 10 years. Corporate inversions are when companies move their headquarters abroad through merging with foreign firms or acquiring them outright in order to shift their tax bases abroad. Since 1982, more than 50 U.S. companies have reincorporated in low-tax countries, including more than 20 since 2012. What makes companies want to undergo inversion? Companies are expatriating the United States due to high corporate tax rates. Corporate taxes are taxes on a company's revenue. Since corporations are legal entities distinct from their owners and operators, they are typically taxed as if they were people. Even with the reductions of the Tax Cuts and Jobs Act, which lowered corporate taxes to 21% in 2017, when combined with state corporate taxes, which range from 3 to 9% depending on the state, the average corporate tax is 24% in the United States. This is higher than the worldwide average of 23% and also higher than other developed nations including China and England, which both have rates of 23%. For example, say Company A in America acquires Company B in Ireland. The managers of the combined A plus B entity get to choose a domicile. If they choose the United States, they are in effect choosing to pay a relatively high American tax corporate rate, up to 39% depending on the state. If they choose Ireland instead, however, they will only have to pay a much lower tax rate of 12.5% on the profits generated in Ireland. The kicker, however, is that they will only additionally have to pay the local rate on whatever profits are generated in foreign subsidiaries, because Ireland, like most other countries, taxes on a strictly territorial basis. So, why is this a problem? Due to the high corporate tax rate, the United States cannot compete with other countries. When companies move their headquarters out of the United States, they take their capital and job market with them. This causes stagnation in the U.S. economy and discourages foreign investments. In the long term, the government will lose money. On the calculations of S&P Capital, American targets valued at $315 billion were lost to foreign mergers last year, which represents a major decrease in tax revenue. Because of this decrease in revenue, it is estimated that strengthening legislation to limit inversions would save the taxpayer an estimated $19.5 billion annually. Corporate inversions also pose a threat to the ideological fabric of the United States. The U.S. has historically been known as the home of free market economy, yet businesses are leaving at an unprecedented rate because high corporate taxes have created an adverse climate for business in the U.S. Another major problem facing the United States that is aggravated by inversion is unemployment. Though unemployment has decreased to 4.5% in the past 5 years, it still affects many people, including 3.3% of adult men, 3.4% of adult women, 3.4% of whites, 5.9% of African Americans, and 4.5% of Hispanics, according to Trading Economics. Additionally, the influx of dreamers and immigrants puts more strain on the job market because more jobs are needed to support the growing population. Expatriating companies exacerbate this issue, taking jobs out of the United States. So, if the corporate tax rate is causing companies to leave the United States, why don't we just lower the corporate tax rate? The question is not that simple. The sum of all outstanding debt owed by the federal government is currently at $21 trillion. In simple terms, to repay this debt, the United States needs to either cut spending or increase tax revenue. Cutting corporate taxes, however, decreases tax revenue. Also, from a partisan standpoint, with a Democratic majority now in Congress, such tax cuts would be difficult, if not impossible to pass, because Democrats believe that corporate taxes unfairly advantage powerful interests. Another aspect that plays into corporate inversions is the U.S. policy of deferred foreign income. The U.S. taxes companies on their worldwide earnings but allows them to claim foreign tax credits for profits earned abroad and defer U.S. taxes until they bring that money home. Though the policy of deferred foreign taxes is beneficial for businesses because it encourages their international growth, coupled with the 24% corporate tax rate, it pushes companies to earn money abroad in low-tax countries and just leave it there. U.S. companies now have more than $2.6 trillion in stockpiled offshore profits that have yet been taxed. In fact, a recent study done by J.P. Morgan showed that 60% of the cash held by 602 U.S. multinational companies are sitting in foreign accounts. So, what can be done to fix this problem of companies inverting? My proposed policy is to impose an exit tax on corporations expatriating the United States, or, in other words, moving their headquarters out of the United States to decrease corporate taxes. Basically, these corporations would be taxed an additional sum when moving out of the U.S. An exit tax would mirror the U.S. system that uses tax to tax the retirement of individuals who renounce their citizenship. This exit tax would also be coupled with refunds and deferred interest for companies that would return deferred capital to the United States. More specifically, the proposed policy would have three facets. Firstly, the levied exit tax for expatriating companies would be the greater of two calculations. One, the tax owed on the deferred foreign income of a U.S. company's foreign subsidiary, or two, the tax on the appreciation in value of the subsidiary. Secondly, the policy would prevent inversions for tax purposes unless the shareholders of the foreign company own most, 80%, of the merged company. Thirdly, companies who return their deferred funds stockpiled in foreign funds will be offered tax refunds on the amassed deferred interest. This facet of the exit tax policy would not change the U.S. policy of deferred interest, which would anger U.S. businesses abroad, but rather encourage companies to invest money in the United States in spite of it. Like all imposed taxes, this policy would be enforced by the IRS, the International Revenue Service, which taxes on a national and international basis. Why would this policy work? Imposing this coupled exit tax policy, which provides refunds on deferred interest, would kill two birds with one stone. First, it fiscally discourages companies from moving out of the U.S., which would decrease corporate inversions and keep capital within the United States. Second, refunding deferred interest for companies would encourage companies to invest in the United States. A study done by J.P. Morgan found that incentivizing companies to return money in foreign accounts through refunds would cause an estimated $663 million to be invested in business expansion and job growth nationally. This policy would most directly impact U.S.-based corporations. Yet, more capital and investment coming into the United States would benefit the average consumer as well, because increased investment yields increased salary, increased jobs, and increased material output. In conclusion, of course, this is not a comprehensive solution to unemployment or the whopping $21 trillion of debt the United States is currently in. However, the exit tax policy with refunds would prevent companies from simply taking their money and running away, or, so to speak, inverting and skirting. More importantly, though, it would create a more favorable U.S. economy for business, not only encouraging new foreign investment, but stimulating the United States economy and setting it on the right track.